So let's talk about risk. Risk is very important in any type of investment environment. And when we look at the investment of antiques and collectibles, it's a very important factor that we need to consider. So in this video, I'm going to give you my 3 golden rules, my 3 golden statements on assessing risk that I share with a lot of the clients that come to me through my consulting business asking about investing in antiques and collectibles, especially over the long term. So before I go any further in this video, I want to take some time and I want to define risk from a financial perspective. Now, the best definition of risk as it relates to finance and investment I can find online is on the website known as Investopedia, www.investopedia. So I want to give credit to Investopedia for providing us all with this definition that I'm going to read to you before we get into the crux of today's video. So risk is defined in financial terms as the chance that an outcome or investment's actual gains will differ from an expected outcome or return. Risk includes the possibility of losing some or all of an original investment. Remember, guys, when we talk about investing in the antiques and collectibles trade, these are alternate asset classes. There are no underlying cash flows linked to any of these items. If you go to the market, you pay $10,000 for a vintage comic book, a rare coin, a Pokemon card, a vintage Star Wars figure, and you put it in a safety deposit box, you come back 20 years later, you will still have that same item in that safety deposit box, meaning you will not accrue any type of dividend, any type of cash flow from that item until you go to sell it on the secondary market. This is very important because the opportunity cost of investing in the antiques and collectibles trade, especially over the long term, needs to be compared against other investment choices, mainly investments in index funds, ETFs, mutual funds, stocks, bonds, and even real estate. When you invest in the antiques and collectibles trade, make no mistake, I don't care what market you're investing in. Some markets are inherently more risky and more speculative than others, but there is always a massive amount of risk in choosing to place your money in these markets over the long term. So let's get in to my 3 golden caveats, my 3 golden rules or statements of how best to deal with risk when we're attempting to invest in the antiques and collectibles trade. Rule 1, we should own more of a risky investment when its expected return is higher or when its riskiness is lower. Now, this is very hard to assess sometimes in the overall antiques and collectibles trade because I've said this before, I'll say it again. If we want to look out 6 months into the future and we want to guess what's going to be popular, what's going to be hot, what's going to be coveted, it's very easy to do so. Obviously, right now, people are collecting comic books, rare coins, video games, toys, Pokemon, even Magic the Gathering. That stuff is still going to be popular and collected 6 months from now, just as it is today. This is very easy to predict. You don't need a crystal ball to do this. However, what if I told you, tell me what's going to be popular, what's going to be very much collected 20 years from now? Do you think you can do it? Do you think you can adequately say that the markets I just mentioned are going to grow exponentially over the next years to the point that when we look 20 years into the future, those markets are still going to be hot? Because if you're sure on that, please understand that you got to be very careful how you analyze these markets, not only over the short term, but also over the long term, because you're making a key mistake here. This is why I get into so many arguments with a lot of you guys when I do videos and I bring up Pez, or I bring up Lionel Trains, or I bring up Western toy collectibles made by the Marx Company, or I bring up other type of pop culture collectibles. And I tell you guys, if you get in my DeLorean time machine and we go back to the 60s, 70s, or 80s, you're going to see, for the most part, on the pop culture side of things, what people coveted, what people collected back then, is not the same as what they're going after in the year 2024. And I think some of you really need to understand that, because if you're going to the market now and you're buying certain items and you're putting them away for 20, 30 years, you need to realize that in most cases, in that time period, what people are going to covet, what people are going to want to buy is different then than it is today. This is why when you invest in antiques, you are investing in history. When you invest in collectibles, you are investing in nostalgia. Nostalgia changes, nostalgia fades. History stays stagnant. Let's be realistic. If I pull out of my collection a signed letter from President George Washington after the Revolutionary War was won, that particular letter that is coveted today in 2024 will most likely still be coveted in 2054. Now, obviously, I can't tell you what it's going to sell for in 2054. I don't know if the return in 2054 is going to be higher than simply putting the money, the value of that item equivalent, in an S&P 500 index fund. But what I could tell you is I have more faith in the letter signed by George Washington being put away for 30 years than I do any comic book, any Pokemon toy, any Pokemon collectible, or any other vintage item. This is something that you guys need to realize. History is on the antique side of the equation. Collectibles are on the nostalgia side of the equation. When you analyze risk and you look at it from that standpoint, things become much more clear. Things become much more transparent. Now, one caveat before I move on from this standpoint. Understand that antiques can still die out. If you look at Tiffany glass, if you look at certain items on the antique side of the equation, Hummels are a great example. A lot of these items can pretty much start to decline in value. They're not always going to be a good investment simply because they're more than 100 years of age or older. You still have to make good decisions if you're attempting to invest on the antique side of the equation. A lot of times, 100% legit with you guys. I don't mislead anybody in any of these videos. It's a lot easier to predict items on the pop culture side that are going to be popular over the next few years than it is to predict what antiques are coming into vogue, what antiques are dying. Now, of course, if you're investing in high-end historical documents, art, coins, currency, those markets are alive and well, and most likely 30, 40, 50 years from now, those particular markets will still be alive and well, with few exceptions. Now let's get on to my golden rule, my golden statement, whatever we're calling these particular facts that I'm giving you about risk. Let's get on to number 2. The expected aggregate real returns available in the market are a direct function of supply and demand. Let me state that again because we need to break this down. The expected aggregate real returns available in the market, meaning the collectibles trade, are a direct function of supply and demand. And what most people do not understand about investing in the antiques and collectibles trade, it's not so much supply that you have to worry about, it's demand. Even if more supply is found, like if we look at Pokemon cards, if we look at vintage toys, if we look even at factory sealed video games, if we look at comic books, there's always going to be that old guy in his 70s and 80s that squirreled away a lot of this stuff in near mint condition that ends up dying. Somebody finds this stuff and they bring it to the market. Now that's adding to the supply side of this equation. Well, if there's enough demand to scoop up that added supply, it really isn't going to matter much. The secret to investing in the antiques and collectibles trade is understanding that demand is always changing. Case in point, if we go back to the year 2020, if we go back to the year 2021, when comic books were hitting all-time highs during the wonderful pandemic, when everybody was stuck indoors, when a lot of collectible prices were soaring to the stratosphere. If we go back to that time period, that was due to increased demand. Demand for a lot of those collectibles, we now know, was at an all-time high in 2020, 2021. Compare this to what's happening in 2024, demand is much lower. That's why when you guys were coming to me saying, Sean, you don't know what you're talking about. It's 2020, it's 2021. This is a new market. This is the way it's always going to be. I'm putting all my money in Pokemon cards, graded video games, comic books. What is it that I told you guys? It's not going to last. These are all speculative highs. Demand cannot sustain that level of hype that it was at during that time. I saw this in the market and I pulled back my buying. You guys can go back, watch my videos. You will see I firsthand told you guys to use a lot of caution in these markets at that particular point in time. Well, today in 2024, we can see the result of that. Demand is not as high. So what a lot of you guys are hoping, if you're investing in some of these markets in 2024, now that prices have pulled back 10, 20, 30, 40, 50, in certain cases 60%, you're hoping that demand is going to increase sometime in the future so that if you bought today in 2024, you could get a substantial gain by selling that item when demand increases. If that's you, you still have to use caution in these markets. Let me give you a great example. If we get in my DeLorean time machine and we go back to the year 2008, 2009. Now, what was so significant with vintage comic books? What movie came out in 2008, 2009? It was the very first Iron Man that introduced us all into the potential of the Marvel Cinematic Universe. And to be 100% fair here, Robert Downey Jr. played an excellent part. He was born to play the role of Iron Man. We all can agree on that, most likely. That movie was a blockbuster, and it showed us what was possible with the cinematic talents behind the Marvel Universe at that particular point in time. Well, I hate to say this. I told you when I started this channel, and a lot of you wanted to argue with me, eventually people are going to tire of comic book movies. Well, here we are in the year 2024, and both the Marvel Cinematic Universe and the DC Cinematic Universe are kind of in shambles. There's a lot of questions that are popping into people's heads. There's a lot of these movies that just are not doing well at the box office anymore. It just seems to be that a lot of people, a lot of comic book enthusiasts have soured on these movies as well as the general audiences, meaning just the casual enthusiasts that want to go to the movie and watch a Spider-Man flick or an Iron Man flick or maybe a Batman movie. It just seems that those particular individuals, as well as the hardcore fans, really soured on what is being put out on a regular basis. This means that in the year 2024, there's much more blood in the streets. It's a lot more riskier to invest in comic books now than it was back in 2008, 2009, 2010. And I know what my critics are going to say. Well, Sean, back in 2008, 2009, 2010, we had the financial crisis. Things were still crashing all around us. Well, yeah, in 2024, though, we still have an uncertain economy. And we still have extremely high interest rates compared to the interest rate environment that we came from. Please don't cut me up in the comment section below if you're over the age of 50 and you remember the high interest rates we had in the late 1970s, 1980s. Thank you so much. So with that being said, you have to understand that there still is risk in investing in these assets at this particular point in time. Now, my third rule, or my third statement about risk, is that successful investors know that expected returns change over time, and they are reasonably able to estimate how they are changing. This is where a lot of you guys got to let go of your emotional attachment to these items and become just a little bit more logic when you analyze how these markets are playing out, what's going on in regards to the overall macroeconomic environment that we find ourselves in. Instead of saying stuff like, Sean, you don't understand, it's Pokemon. Everybody loves Pokemon. Look, let me tell you guys something. Right now, demand for Pokemon cards and collectibles is at an all-time high. A lot of you guys are kidding yourself because even me, I have a lot of money that you don't see invested in vintage Pokemon products. And I'm here to tell you, when I go and I look over like the PSA census, I see a lot of these coveted vintage cards that literally have thousands of items or copies out there in PSA 10 condition. I don't know what is going to cause demand for vintage Pokemon products along with modern Pokemon products to skyrocket over the next 10 to 20 years, where people are going to be paying a premium for this stuff because there's so much of it out there. A lot of the gains that have been achieved in the Pokemon market, in the vintage toy market, in the vintage comic book market, in the last 5 to 10 years, I honestly don't believe those gains are going to be replicated in the next 5, 10, 15, 20 years. And you guys will be able to prove me wrong if that census comes out incorrect. Meaning, if we're going out 5, 10, 15 years and you guys see, hey, these returns, they're exponentially increasing, that could happen, but I don't see that happening as a valid response to how we got here, where everybody views antiques and collectibles as the ultimate asset class, where you have little Timmy Kimmy Poindexter Jr. in their 20s, not understanding that they have time value of money on their side if they would just put $100 or $200 a month in an S&P 500 index fund, instead of trying to put it all in modern era Pokemon products, video games, Nike Air sneakers, and cryptocurrency. But alas, in 2024, telling you guys how to understand risk, like I just did in this video, and telling you that in certain instances, you would probably be better off creating a well-diversified portfolio for yourself. That's considered controversial because we all know the whole economic system is going to crash and people are just going to be going after gold, cryptocurrency, and collectibles. Now, again, if you want to believe that, that's you. I'm a little bit more liberal when it comes to investing in antiques and collectibles, to the point where I tell you guys, you can put up to 20% of your net worth in speculative assets, whether it's gold, silver, crypto, and collectibles. Most financial advisors will tell you 3 to 5% at most. Again, I made a lot of money in the antiques and collectibles trade, so I do have a bias towards these markets. But I also understand how these markets work. Most people do not, unfortunately. And in the year 2024, it is apparent that a lot of the Timmys, Kimmys, and Poindexters are leading the proverbial masses to their grave when it comes to giving advice about investing in these markets. So that's how I'm going to sum up this video. Just understand these core statements, these 3 statements that I gave in this video on risk as it relates to the antiques and collectibles trade. If you take this advice, you will be a much more successful investor, collector, dealer, or speculator in these markets going forward. Thank you for watching. Let me know your thoughts in the comment section below.